Hi everyone, my name is Peter, and I'm delivering a series of lectures at the Eagle Academy, the first of which is dollar cost averaging. But first I want to introduce myself. I work full-time as a quant for a large institution performing market making and other hedge trading activities, but I love to work at Eagle additionally in that I get to connect with other traders and I get to continue teaching. I used to be an engineering professor and I really missed teaching when I stopped and started working in the financial sector, and so being a moderator at Eagle really keeps that passion alive. So I hope you guys enjoy the lectures, and so let's begin. Alright, so let's talk about dollar cost averaging. So first of all, let's talk about what is dollar cost averaging. Dollar cost averaging is when you are averaging your entries or exits in a position over time and price. So if you look at the illustration here, you see this is an example on the right of someone not dollar cost averaging, in which they just lump sum invest on January 1st. And then if their entry was good, then great. If it wasn't, then they're out of luck. As opposed to the person on the left, dollar cost averaged into that position. And so that position had an average entrance or exit as opposed to just being at one point in time. So how do you dollar cost average? You could do this automatically, setting up a bot or configuring something on your brokerage. You could also do limit orders, and this would do price dollar cost averaging. You can also do it manually, in which you go in and enter or exit yourself. So let's talk about why would you dollar cost average. So bias is something that we traders constantly struggle with. We have time and direction bias, in which the market also has a lot of volatility, and so it can swing against us in those biases. And so when we dollar cost average, we are able to reduce some of this natural volatility that is in the market, and ultimately reducing our trading bias as well. So you can also modify an existing entry that you had. So if you entered too high, then you could enter lower, and then this sort of makes up for some of that poor entry, and it averages into the middle. You have to be very careful about this though, because you don't want to just continue to average down, because then you may over allocate your capital, and you may commit yourself to a trade that just isn't a winner. You don't want to, as we call in trading, catch a falling knife. So let's talk about the types of dollar cost averaging. There is time and price there. So let's look at time first of all. So time, you see that the person here has averaged entries to take place on the first of the month. And so we see the first couple entries end up being pretty high. And then the stock kind of takes a turn against them. And but their entry starting in June, July, and August end up being relatively low, and so the average, they end up getting a better average than if they had just allocated all their capital when they first were able to. Price. So as we talked about earlier, sometimes you take an entry and it's high, and then the market moves against you, and you have an opportunity to make a better entry lower. And so if you've already divided up your capital to give yourself some cash for averaging in later, then you can take that lower entrance. And then when the market moves back up to where your first entry was, you're actually in profit as opposed to just break even. So let's talk about a real world example of dollar cost averaging. This was a series of trades that I made in the trade desk. And I was trading this channel. The two green lines are the extremities of this channel, and I love channel trading because it's predictable, and can be very profitable if you handle it well. So after the channel was formed, I made an entrance at 70.42, and I sold at 76.36, and re-entered at the touch of the channel bottom again. At 66.18. From there, I began dollar cost averaging out of the position at 72.94. The reason why I chose to average out as opposed to just exit like I had in the previous exit was because we had confluence for the bottom being in with that major pivot, and so I took some out at 72.94, but ultimately the market continued up, and that ended up being a good situation because I was able to exit at 81.95, utilizing the pivot as well as the decrease in momentum that was happening at that point. And the market moved down. I looked to compound back into it, but I dollar cost averaged into it at 76 and 74. 76 was still too high, had some swings, and then I entered lower at 74. And if I had even allocated more capital, then I could have taken an entrance around November 7th or so when it really went low. But yeah, I had already maxed out my allocation for that asset. But the market ended up going up, and that averaging ended up working out very well in that trade. So that's a good example there. So in closing, dollar cost averaging is helpful for reducing our bias in time and price. As traders, when we look at the market, we may, be in a certain mood or have certain things happening to us in time that give us a certain bias. For example, if you receive a paycheck, you may say, okay, I have all this capital now to allocate, and so you may just put it in the market. But let's say that the market was at in a broader scale, the indices were at a topping point, and then you see everyone in the market going down while you're underwater, either stopped out or underwater. And so if you dollar cost average in, and instead of just putting all that capital in the beginning, you allocate some of it then, and then you hold some of it for a lower entry, then you would have gotten to take advantage of that lower entry. So continuing the summary, dollar cost averaging overall is great for reducing volatility and reducing the negative emotions that can happen when your own bias proves to be ineffective against the market. So if you still have capital to allocate and you haven't allocated all your capital, the market turns against you, then you can sort of feel positive about that, and you're like, okay, great, I now have an opportunity to average down lower. And or if you exit on the flip side, you exit a bit too early, you still have some in the trade that you can take profit from at a higher price. So hopefully that was helpful in summarizing dollar cost averaging.